Hey, everybody, it's your boy, Sean McLaughlin, at Option Sean on the old Twitter X. Hope you guys are doing well. Welcome to the new show. What are my options? Sometimes you just like to know, what are my options? Little fun play on words. I hope you guys are doing well. So this is a new show. We're figuring it out as we go along, but the goal here is to share a little wisdom, share a little knowledge, and to hey, let's talk about some ideas. If you have ideas about stocks or ETFs that you're interested in putting on, but you're interested in what's a good option strategy to participate in those trades, I'll be taking requests in the chat. And I got it right up here on my screen, so I'll see it. So if you have something you're looking at, or something you're curious about, or have a question about, pop it in there, and we'll try to get to it. Hopefully, we won't be overwhelmed by questions. And thanks to the big shout out to the All Star Options community who in the days leading up to this have put together a big list of stocks for me to talk about. They want me to cover. I'm not going to be able to cover all of them. There's too many. But we'll definitely get into it. But before we start digging into some ideas. A question did get emailed to me this week, and I won't read it, but the gist of it is the writer wanted to know, how do I choose between a bull call spread that's a vertical option spread, right? A bull call spread is a trade where you buy a call, let's say, and you sell a further out of the money call against it. It's a debit. Whatever you pay is the most you can lose. And of course, your gains are also capped due to the short option. He wanted to know, how do I choose between doing a vertical spread like that, a bull call spread, versus say a call calendar spread? A call calendar spread is where you are long a further dated option. Okay. Let's say let's say I bought January calls, right? But then I sold that same strike. I sold short options in a shorter dated month, let's say August. So I would sell an August call against my July call at the same strike, and that lowers my total cost of participation. Okay. And a calendar spread and a vertical spread have different payout diagrams, and I'll show those in a second. In fact, you know what? Let's do this right now. Gene, let's bring up my screen here. I'm going to bring up my trading platform, and we're going to kind of go through. We're just going to go through a hypothetical explanation of what these two trades are. I know for some of you guys, this is rote and very basic. I know, but there's some of you who are new to options and learning. So let's just pull up the SPY, and let's say I wanted to buy a vertical spread in SPY, and I'm looking at August options, not for any particular reason, but just because, just for just to oh, actually, let's do this. Just for demonstration purposes. So let's bring up the August. There we go. I don't know what this is. Let's get this out here. So I'm going to set up a dummy trade here in, wow, a lot of scrolling. Let me do this. Here we go. I'm going to set up a dummy trade here in the SPY. Let's say I'm going to buy well, that's the wrong expiration. Let's go to August. Well, there we go. All right. I'm going to buy an at the money, just out of the money bull call spread. So I'm going to buy the August 620 calls, and I'm going to sell the 630 calls against it. And this is just a hypothetical bull call spread, a vertical spread. You'll notice here on my screen, I set it up where I'm long the 620, short the 630. It's going to cost me about 523 to put this trade on. That's 523 times 100 shares. That would cost me 520 bucks. All right, now let's look at what the risk profile of this looks like. Oops. Did we not analyze that? Here we go. Bum, bum. Okay, so this is what the P&L graph of a bull call spread in the SPY looks like. You can see right here, this purple line is how the P&L would trend today. You know, if the SPY were to trade up to 640 today, you would see I'd be up about 277 bucks. If it traded down to 610 today, I'd be losing about 87 bucks. It's kind of highlighted right there by my mouse. The blue line is what the P&L would be on expiration day. Okay, so along the x-axis here, you have the prices of SPY, of the underlying, right? That's the SPY. And along the x or the y-axis, this is actual P&L, right? These are dollars. So it's a bullish bet. This is where we are right now. Okay, if I were to put the trade on right now, that where the purple line crosses the zero line, that's zero because I haven't put the trade on yet. But if I were to buy it right now, this is how my P&L graph would look. Okay. Now you can see as we get to expiration day, which is the blue line, my potential gains are capped above 330. That's where my short call strike is. Okay. My gains are capped. Can't make any more beyond that. The most I can make in this case would be about $4.80. If it cost me 520, say 520 to get in, the most I could make is 480. How do I figure that out? Well, you calculate the difference between the two strikes. In this case, it's the 620 strike that I'm long, the 630 strike that I'm short. That's $10. That's the most the spread could be worth. Well, if I paid 520 for it today, then you figure you do the math there, and the most I can make is 480. Okay, but the plus side is I also know what my max risk is. The most I could lose is what I paid for it today. Okay, so this is what a call vertical spread P&L graph looks like. Now the reader wanted to know, how do I choose between doing that or doing this type of trade or a call calendar spread? So a call calendar spread sets up differently. Let's create a new trade here, a call calendar spread. Let's say we'll do it at the 620 strike again. We're going to analyze a call calendar. Let's see. Why is this not working for me? Delete this. Okay, here we go. So we're going to set up a calendar spread where we are short the August calls. Get out of there. And we'll get long the, let's say, December. Okay, same strike, 620s. I see these here. I'm short the, see the -1. I'm short the August 620 calls and buying the December 620 calls. In this case, it cost me $18.39. Now let's look at the P&L graph. Now you can see with the stock trading, with the market trading right here, this is where we're at if we were to get into this trade right now. This trade, you want the market to kind of stay right where it is. You know what? Let's change this up a little bit. On that vertical spread we did before, we did a 620, 630, right? So let's just keep the strikes, the targets similar here. So let's make the target a 630. All right. Now we're right here. This is see this. Yeah, there we go. You can see this is where the market is right now. So if I were to put a calendar spread on this, also is a bullish bet, right? You can see the purple line is trending higher, which is my P&L across, you know, today at a range of prices. It's bullish up to a point. It starts to bend over once we get to the strike. But the guy wanted to know, why would I choose a call calendar spread over a vertical spread? Well, that's a very good question because there's usually two very different goals I'm trying to achieve. With a vertical spread, you know, let me set up that vertical spread here real quick. Analyze a vertical spread, 620, 630. There we go. Okay. So with a vertical spread, we clearly are bullish here, right? We want the stock to go higher, and I make money if it goes higher. I lose money if it goes lower. Okay. Now with the call calendar spread, the P&L graph looks different. In fact, it gets negative once you get past the strike of 630. The reason I would choose a call calendar spread versus a vertical spread in cases where I'm bullish in both situations is because really what I'm trying to accomplish with the calendar spread is I want to be an owner of these December 360 calls. These are the calls that have 6 months to expiration. I want to be in that trade, okay? But I don't want to pay full price for those December calls. Those December calls are expensive right now, right? Maybe I don't want to risk that much. Maybe I don't have that large of an account. Whatever the reason is, whatever the full price, I mean, let's pull it out. Let's look up real quick. The full price of those December calls right now are $31 a contract right here. Okay, that's 31 times 100. That's $3,100 I'd be risking on one contract. Okay, look, if I have $1 million account, risking $3,000 on one contract, no big deal, right? But if I have a $100,000 account, well, now we're talking real money here. Now that's a sizable percentage of my assets, more than I'm comfortable risking. All right. So if I want to own these December calls, but I don't want to pay full price for them, then I will do a calendar spread. And when I do a calendar spread, instead of paying $31, you'll notice here, my net debit is actually 17, almost cut in half, right? Sweet. And how is that possible? It's because I'm selling the August call against it. The August call is trading for about just under 13 bucks. So that's lowering the cost. Now, let's bring up the risk graph again. it's lowering the cost. Now that the bet I'm making and the hope that I have is that I'm positioning in those December calls at a lower dated or at a cheaper price. And I'm willing to bet that this thing's not going to rip in my face between now and the expiration of the short option, which in this case is the August. I think, if I'm putting this trade on, I'm getting this SPY is going to, trend up a little bit. It's going to go my way, and that's great, but it's not going to go too far. I don't want it to get north of 630, which is my strike, because then I start getting on the backside of the slope. Ideally, what I want to happen is I want SPY to trade up just a little bit, maybe settle in this area here. And then on expiration day, those short calls in August expire away worthless. And now I'm left with the December calls at a lower price with, at that point, theoretically unlimited upside. So that's why I would choose a calendar spread, because I want to lower my cost of participation. There are sometimes, I don't do this a whole lot, but sometimes around earnings or kind of unusual market situations, you might find a situation where there's a lot of premium priced into shorter dated options versus the longer dated options. Usually that happens around earnings or some kind of binary event that's coming up and people are hedging their risks in the shorter dated options. Sometimes you'll get a lot of premium for those short dated options, and you could just sell the short dated options, buy the long dated options. And if the stock does nothing at all, you'll just benefit from the volatility is coming back in line, and that'll work out too. I don't do a whole lot of those trades, but that's another reason why people would do calendar spreads. All right, take a breath. I hope that was instructive, at least for the person who asked it. I hope it's instructive for the rest of you. Both can be bullish bets. Some people will put calendar spreads on, putting them on as a neutral bet, right? Like if I could change these strikes to 620, which is right around where the market is right now. Actually, let's put it to 615 because a SPY or 620. Let's just do 620. We could do it right 620, and here's where the market is right now. So we're basically at the center of the structure. If you put a calendar spread on with strikes that are right where the market is right now, then you're basically putting on a delta neutral bet. You're betting that the market's not going to go too far in either direction. That's a viable trade as well. It's a similar trade to say like an iron condor where you're betting on price stability, right? You're selling it out of the money put spread, you're selling it out of the money call spread. Similar idea, different execution. But calendar spread could be a very, very useful trade. All right. Now, like I said, we're going to be soliciting tickers and trade ideas from you guys. I had a big list sent to me already. And so I'm just going to cherry pick a few of the names that actually caught my attention. The first one is Toast Inc. TOST. You know what? Let me do this. I also have other charts here. I like these charts better, and I want to bring this up. Actually, no. See, it's the first time we're working out the wrinkles here. We're working out the wrinkles. I just had one real world example I wanted to show you about a call calendar spread before I move on to Toast. Here's Take Two Interactive. This is a trade I'm in right now. Okay, I've been in this trade for a while. I got in this trade back in February, and I did a version of a call calendar spread. In this case, was a call diagonal. That's a close cousin to a calendar spread. The only difference is that you're doing different strikes. Okay, so in this case, I shorted April 240 calls, and I got long the August 250 calls. So almost a calendar spread, not quite, because the strikes aren't exactly the same, but they trade similarly. And when I put this trade on back in February, I wanted to be long those August 250 calls. I just didn't want to pay the full price. I mean, I think they were going to cost me about 12 or 13 bucks to buy them, and I didn't want to spend that much. I thought that was too much. So I was able to sell the April 240 calls, and that cut my cost down dramatically. And my net cost ended up being 750 instead of 1250, I think is what it would have been. And my goal was, as with a regular call calendar spread, is I wanted the April calls that I was short, I wanted them to expire away worthless. And they did. Here's April expiration day, right about here, April 15th, I think was the date. And as you can see, the stock was at 215. We can zoom in here a little bit if we need to. Right here, the stock was around 215. The highest it got was 221. My April 240 calls never got in the money. And so they expired away worthless, left me long the August 250 calls, and I'm glad I held on to them, because look what we're doing. The stock has been just slowly grinding higher ever since. Stock's now trading around 240. My August 250 calls are still out of the money, but we're heading in the right direction. It's exactly what I wanted. I wanted those short calls to expire worthless, and now I'm in these August calls at a discounted price. All right. So that was my real world example. Now let's get to a current example or a trade idea that somebody was asking about. They wanted to ask about Toast, T-O-S-T. You could see here, we had a big run up here at the end of last year. In fact, it was a trade I was in. I got the details here. It was a bull call spread that I bought for 250 and sold for 660 a little later on. I mean, I could have held out for a little bit more gains, but I'm glad I got out when I did, because I would have got caught in this and the position never would have regained, I don't think. But that's neither here nor there. Let's talk about where we're at now. Toast, I believe this was an earnings gap back on May 9th. Gapped up. It came basically right up to the previous cycle highs. I mean, it got a little above, but now it's just been hanging tight here, consolidating nicely. We like to call these bull flags. This is definitely a bull flag forming here. I like the way it's holding up above this rising 50-period moving average, which is the blue line, and the yellow line is the anchored VWAP off of the April lows. I like how the stock reacted during a recent pullback. Yeah, this is a stock I like. And now the question is, how would I trade this with options? So I'm going to go back to my platform again. I hate to keep flipping back and forth with you guys, but I need to, because one of the key things I pay attention to when I'm thinking about putting a trade on is look at the bottom of my chart here. This is the implied volatility chart for Toast options. I don't care about what this number is, this 0.519. That number is not important. What's important to me is where are we now compared to where we've been over the past year. Generally speaking, if we're in the lower part of this screen, I like to be a net buyer of options, either, buying calls or buying debit spreads of some kind. I like to be a net buyer of options because options in this environment are cheaper than they've been, let's say back in early April when we were at the top part of this chart here. The top part of April, or the early part of April, options were very expensive. So if I were looking to get either long or short Toast at that time here in April, I'd be looking to put on some kind of spread or some kind of trade where I'm short options. Maybe not naked short options, maybe, but generally I want to be short premium, because there's an edge there, that the volatility is likely to mean revert and come back down, and that will just boost my profitability or boost my edge in the trade. So looking at Toast right now, volatility is, it's not at the lowest it's been. It's off the lows, okay, but it's in the cheaper range of where it's been. So for me, my first thought at looking at before I open up the options chain is I probably just want to be a buyer of straight calls here. Just keep it simple, right? And I like to be, I'm not 100% on this, but I generally, if I'm going to buy naked long calls or straight long calls, I like to target around the 25 delta. So let's open up an options chain here, and let's go, I don't know, I'd probably go at least 3 months out. So probably look at October options. Or I guess I'm in the middle, right? I could either choose September or October. Let's just choose October. And I've got my delta column here along. These are the calls on the left side of my screen. And the closest to the 25 delta strike appears to be the October 55s. Okay. So October 55s, I could buy, that's the bid of 104, offered 123. So if I put a limit order in to buy this call for, let's say, $1.10, maybe $1.15, I feel pretty confident I would get a fill. And check this out. I mean, let's analyze this trade. Analyze a buy, analyze a single. Now, this is what the P&L graph would look like if I put this trade on today. Let me kind of clean this up for you guys a little bit and delete that, delete that. So here's where we are right now. Okay. Oop, I got to move this. There we go. Here's where we are right now. And as you can see, heading to the left, as on the x-axis is the price of Toast, right? The underlying stock. If Toast goes the wrong direction on me, my losses are limited. Oops, let's take this out here. Let me clean this up. I realize it's messed up because I have a trade in there already. So let's just show let's just show the simulated trade we're doing. So you can see if we head this way, I'm not going to lose a whole lot. The most I could lose is the buck 17. It looks like I pay for this call right now, right? That's the most I could lose. But if we go up, move this chart a little bit this way. If we go up, my gains are theoretically unlimited. The option will begin to trade almost 1-to-1 with the price of the stock. It has a 25 delta right now, but as the stock goes higher and as the option gets closer to the money, it's going to start gaining deltas. At which point, if the stock trades up to 60 bucks and it's, late September, the option is going to basically trade 1-to-1 as if it were stock, as if it were 100 shares of stock. And we have theoretically unlimited upside at that point. So I think if I were to do Toast right now, I would buy these October 55 calls. I'd probably pay about $1.15 for them. I'm going to put myself in a position to ride, right? Now, there's a couple schools of thought on options. And a school of thought that I've certainly preached from the rafters for a long time. I'm changing my tune on it, just personal preference, not because it's bad. But maybe for some of you who are newer and just trying to figure your way around money management when it comes to options, sometimes when you just buy a call, maybe a good risk management or money management scheme for you is to buy the call. Let's say you buy more than one. Okay. Let's say you buy 5. Let's say you buy 10 calls. Let's just keep the math simple. You buy 10 calls. When the stock, if and when the stock starts going your direction, if you paid $1.15 that we're looking at right now, if you could sell half of them for $2.30 once the stock starts moving, that's double your money on what you paid. If you sell half of them, if you sell half your position, then you've just paid yourself back what you paid to get into the trade. And now you're left holding half a position with essentially no risk. I mean, yeah, you have open profits that you're risking, and that's okay. Risking open profits is what the pros do. That's how you get big wins. Is you got to risk those open profits. Um, but mentally you're in a much better place right now. You basically have a free ride. I like to say hashtag free ride. That's a good way to do it. I'm doing less of that these days as I'm just trying to get more comfortable taking bigger swings and letting things develop. But that's just my personal preference. But for me, certainly what I would do is if I'm buying the 55 calls, right? I would keep an eye on this stock. And if it got up to my strike price, up to 55, especially if it happened sooner than later, like if it happened over the next couple of months, I have until October with these, right? But if it got to my strike price of 55, at that point, I would probably sell enough of my position. Let's say I bought 10 contracts. I might sell 2 or 3 contracts or whatever it would take to pay me back my original investment. Hopefully it'd only be like 1 or 2 contracts. That would be ideal. But if I can do that, if I could just sell a couple of them to pay me back my original risk, then I still have, the majority of the position for a much bigger ride. That's kind of how I do it these days. It's not always I'll look to sell at that strike price. It might be, if I have a chart-based objective, maybe there's some potential overhead supply that could check the rise a little bit. That might be the level where I'll sell some, but yeah, that's it. So, all right, Toast, I like it, guys. I'm not in the trade, or I am in a Toast trade in my personal account, but I'm not in this trade that we're talking about, but I like it. I would consider it. The October 55 calls, currently trading, could probably get filled 110, 115 area. I think that's a great trade. Great idea. All right, the next chart that came up or next request was IBIT, the Bitcoin ETF. Now, this IBIT looks a lot like Toast. I mean, a little bit. Let's pull it up. I mean, similar chart patterns, kind of consolidating near highs. Let's go back to IBIT. Consolidating near highs. I love the way IBIT bounced off the 50-period moving average. I like that volatility is coming in. See this? I mean, this is, to me, speaks a lot. Since April, we've basically been trending lower, and we're near the lowest levels of the year. In IBIT, since inception, I should say, IBIT options began trading in November. You can see right here. So we're at the lowest levels of premium that have been priced into these things since the inception. Why can't I say that word? Inception of IBIT options. So again, not to beat a dead horse and not to be a simpleton. I know some of you guys are here for advanced option strategies, but I think I would just want to buy calls here. I mean, who wouldn't want to have unlimited upside potential in a Bitcoin instrument, right? I mean, come on. So, so I think I'm going to pull up the options chain here. Let's bring up, let's look at least 3 months out again. It looks like we'd have to do September or November. I mean, they got weekly options here, but I generally, I generally just trade in the regular monthly expiration options. When I'll use the weeklies is if I have some catalyst specific trade I'm putting on, maybe it's earnings related, or if on the rare occasion where I want to do something extremely short dated, right? Maybe I'll just buy these options that expire on July 3rd, right? But generally speaking, I'd say 98% of my options trades are all in the regular monthly expiration options. Mostly because that's where most of the liquidity is. That's where the institutions play. That's where the hedge funds play. The big players, they play in the monthly options. So that's what I like to do. So since we only have September or November to choose from, let's choose November. Let's look in the options chain here. Now, here's the thing. Here's the thing. When you look at a stock like IBIT and you see that the implied volatility is at the lowest level it's been all year, that's great. Okay. That's great. However, there are certain names and certain sectors that, even though it's low relative to itself, option premiums are still through the roof because everybody knows Bitcoin could double overnight. I mean, maybe not overnight, but Bitcoin can double in a hurry, right? So options players are no dummies. They're gonna price in a lot of premium here for these calls. So I mean, the options market right now for a 25 delta call in IBIT in November expiration is pricing in the 77 strike for the 25 delta. I mean, that seems a little far away from me. I mean, let's see. At the April lows, IBIT was trading around 43. And so from 43 to 63, it rallied 20 bucks. The next leg, if there's another move, can another move be 20 bucks from here? Absolutely, certainly. And 20 bucks from breaking out above here would be about 83. All right, so if I bought the 77 calls and paid $2 for them, that means the most I can make on this is probably $4 or $5. I can maybe double my money. I don't like those odds. Okay. Yes, I would love to be unlimited long, or I'd love to have a trade where I have the potential for unlimited profits. But because there's so much premium in these out of the money options, this is the situation where I would like to buy a bull call spread. I would rather buy, let's say, a 65 strike call, okay, like right here, that has a better chance of expiring in the money, and selling those, further, let's say the 75 call against it. So let's analyze what that looks like. Let's put up a vertical spread. We'll set this strike to the 75. So I'm going to buy the 65 call, sell the 75 call. It cost me about $254 to do it. Let's analyze this trade. Oh, did I sell? I meant to buy. Excuse me. Buy. There we go. That looks better. Let's zoom out a little bit. And I'll clean up this chart a little bit. Okay, so here we are right now with IBIT trading around 60. If I buy the 65 calls and sell the 75 calls and pay $254, then the most I can make would be up at this blue line at expiration. If we're trading above 75, the most I can make would be about 750 bucks, because the most the spread could be worth is 10. I'm paying $250 for it now. So the most I can earn on the spread is $7.50, or 750 bucks per one lot. Okay. Now I like this trade because a trade like this increases my odds of success. Okay. How does it increase my odds of success? Well, let's compare. Let me do another simulated trade here. We're looking in November. So we talked about the 77 strike because that was the 25 delta, right? Or let's just do the 75, kind of a little bit more apples to apples. Oh, this is August. We want November. Okay. So let's pretend that we are just buying the 75 calls. All right. So this is what a P&L graph would look like buying the 75 calls. Now, I want you to notice right here. This is where the blue line, this is the P&L graph on expiration day. Okay. This is where I break even. right around, you can see at the bottom of the chart there, $77.64. Now, how's that calculated? It's basically the strike price, which is I'm buying the November 75 calls, plus the premium I paid today. All right, so 75 calls plus 264 works out to be about 77.64. So the stock needs to get all the way here. And this is a cool little thing I could do with this platform. I can move this line over here. And you can see, if you look up at the top here, the kind of faint, I'm sorry if it's hard for you guys to see, but it basically tells you the percentage chance of the stock expiring on this side of the line versus this side of the line. And right now it's showing that we have a percentage. And again, this is just based on statistics. This is not a fact that's going to happen, but there's a just shy of 18% chance that this stock will close above my break even, meaning I'm making money. I have an 18% chance of making money in this trade if I'm just long the 75 calls. Now, 18% might not sound like a good deal, but when it comes with the potential for unlimited gains, then it could make sense. Now, let's compare this to the vertical spread. Okay. And let's move this line to the break even on this trade. Notice the difference here. I've got now a 31% chance of winning in this trade, of the stock closing above my break even level. So I went from, what was it, 18? I went from 18% chance to a 33% chance, right? I'm sorry, this is real janky, guys, but we're figuring it out. So I've increased my odds of success. And why are my odds of success increased? Well, for one big reason, the break-even level is a lot closer. If I'm buying the 65 calls and selling the 75, I add that $2.54 debit to the strike price of 65 of the call that I'm long, 65, and it comes to 67.54, which is right here, which is a lot closer than the 77 something that was over here, right? So I'm increasing my odds of success by bringing my break even closer to the money. And I've got that short call that I'm selling that helps the cost and works in my favor, which could win when a vertical spread's going my way. So in this case with IBIT, I would prefer the bull call spread. If I were to play this, I think I would look in November. I would buy the 65 calls and sell the 75 calls. I might wait though. I'd like to see, I've got a little line here, just kind of an alert for myself. I'd love to see this stock get back up around 62. I think 62 would be the trigger that would get me in. But I mean, you got to love the way this is consolidating. I think this has potential to really ramp and it could happen soon. My boy Louis, our crypto analyst here at All Star Charts, he had a bullish note out today. He thinks Bitcoin in particular, but crypto in general, but Bitcoin in particular is setting up, it's showing the signs, it's setting up for a next big rip higher. And I'm with him, man. I'm with him. So IBIT, I like it. Bull call spread in November. All right. Another ticker that was brought to my attention was AS, American Sports Inc. So let's check this chart out. A similar pattern, guys. We've had breakout hires, and it's just been kind of flagging. It looked like it was breaking out of the flag a couple days ago, but the action of the last 2 days gives me pause a little bit. I mean, check out what the options market was telling us in implied volatility terms. Right when the day we broke out, I mean, volatility collapsed. It was at the cheapest levels it had been all year. Great time to buy calls. But look, just 2 days of selling, and it's got IV moving up again. So that's something to be aware of. If you asked me about this stock 3 days ago, I would have told you I love it. But considering we had a breakout and then came right back into the channel, I think American sports, at least for me, it's kind of a wait and see. Maybe if it gets back above 40, I'd be interested, or above 39.50. And if it does get back up there and volatility does recede, I think once again, you keep it simple calls here. I mean, it's a cheaper stock too. It's a $40 stock. Let's just look at the options real quick. Let's bring up maybe September options. I mean, you could buy, if when we get up to $40, you could buy the 45 strike calls. I mean, they have a 26 delta right now. Obviously these will increase when stock moves up, but you might be able to get these for $1.50-ish. I think that's a good a good price for unlimited upside, right? And as I'm saying this, guys, I should probably point out that overall, let's bring up the VIX. Overall, with VIX at the lowest levels it's been since the freak out, since the volatility freak off back in early April, as volatility is down here near these levels, I'm going to be kind of a broken record. We're going to be seeing volatility in individual names and individual stocks at low levels. And so in this type of tape, and let's just bring up the SPY, I mean, similar story, you can see volatility very low. This is the type of market that if I want to make bullish bets, I'm generally just going to try to keep it simple and just buy calls. If volatility was higher, then we'd do different things and we'd come up with different ideas, and maybe we'd sell some bear put spreads like that, or maybe we'd do some kind of ratio spreads. But for now, in this type of market, it pays to not overthink things. And I'm guilty of this all the time, guys. I overthink shit all the time. All right. I'm the number one offender of overthinking things. Um, just because I have a million tools in my toolbox doesn't mean I need to use every single one of them. All right. Now, I've got some pretty cool tools in my toolbox, and boy, it'd be really cool to pull them out and make a really cool trade happen. But more often than not, that just sets me up for trouble, right? I'm overthinking it, got too many moving parts. I mean, sometimes it's fun to have a multi-legged spread on that's doing all different kinds of things when I have different parameters or when I'm going to adjust or how I'm going to adjust. And that's okay. I do those trades from time to time. But just because I can doesn't mean I have to. And in a market like this that we're in right now, we're looking at the S&P 500 on this chart. It's breaking out. It's a bull market. Volatility's low. Summer's here. Don't overthink it. Okay, just don't overthink it. Don't fight it. Just keep it simple. If you like a trade and volatility, and as long as volatility is not outrageously high, buy calls or buy a call spread. A call spread on expensive stock makes sense, right? Like I'm just pulling up a random high price stock. Like here's Netflix, right? Netflix is a $1,200, $1,300 stock. Stupid expensive. I don't know why these guys don't split their stock. I hate companies that don't split their stock. I hate it. I know they have their reasons and I understand their reasons, but as a trader, I hate it. Okay. It would be very expensive to buy calls. I mean, if I just even wanted to go into, let's say, August, 45 days of expiration, an at the money call in Netflix right now, boy, I got to scroll all the way down. An at the money call is going to cost me $7,000 or $7,400 just to buy one call in Netflix. That's crazy. I don't want to spend that kind of money. I don't want to risk that kind of money for one contract. That's crazy, right? So a trade like this, even though volatility might be low, I'm going to do a spread of some kind, and probably a vertical spread, right? Where I buy like the 1,300 call and I sell the 1,400 against it and make it much more of a reasonable bet. All right. But hey, this is the type of market to keep it simple. So I don't know if I answered the question on AS. I think I did, but I liked this setup 3 days ago. I'm more of a wait and see now. If it gets back above 40, I like it, and I would buy calls. I'd probably look into September and buy the 45 calls for whatever they cost at that time. All right. The other chart that was shared and people were asking me about was EH. I don't know anything about, was it EH or GH? I think it was this one, Guardant Health. Again, similar pattern. We're seeing stocks consolidating at highs. This one's kind of wedging higher a little bit, but looks like a nice, slow, steady performer. Volatility is in the middle of the range here, and I am willing to bet it's because we've got earnings coming up. The last earnings report you can see on my chart here was around end of April. So we're probably getting pretty close to another report out of these guys pretty soon. That might be why elevation or options are elevated. But just for argument's sake, let's look at the options chain. Let's go out at least 3 months. Which, by the way, someone might be asking, Sean, why do you look 3 months out? Why don't you just buy something that expires in like 3, 4 weeks or 5 weeks? Nothing wrong with doing that, guys. Nothing wrong with that at all. My style of trading, I like to consider myself a swing trader. I like to give trends time to develop. I like to win. I like to ride winning trades, for several weeks to several months if I can. And the only way I could do that is I got to position in options that have at least 3 months expiration. So I like to give my trades time. That doesn't mean I always trade that far away. Sometimes I do trade with an expiration only 1 or 2 months out based on whatever catalyst it is I'm seeing. But generally speaking, I want to get at least 3 months out. And a big part of that too is because if the trend that I'm waiting for to develop takes longer than I hope, it doesn't do anything to shake me out, but it's taking longer than I hope for it to develop. Well, I don't want to be getting nickeled and dimed with the theta decay of the options. So for those of you who don't know, all else being equal, if a stock goes nowhere, like if it opens today at 10 bucks and closes tomorrow at 10 bucks, and so no change in price, every day that it does that, we lose a little bit of options premium. It's called theta decay. And as we get closer to expiration, that theta decay in percentage terms increases on a daily basis. Okay. But when you're trading options that have 3 months of expiration or 6 months of expiration and you buy them in a low volatility environment, you're not going to lose a lot of theta decay in those first several weeks or even maybe the first couple of months of the trade because you have a lot of time to expiration. So that's another reason why I like to trade longer dated options. If I'm buying a short dated option that only has a couple of weeks or a month to expiration, I got to be really sure about my timing. Okay, timing is everything in that situation. Not only do you have to get the direction right, and not only do you have to have the trade structure right, but you have to have the timing right. You need whatever you want to happen, you need it to happen quickly. The sooner the better. I don't like to put that kind of pressure on myself. I like to identify trends that are developing and maybe waiting on a catalyst, but maybe I could get in a little early. And so using the longer dated options helps me in that goal. So with that said, with Guardant Health, I would probably look into at least October. The 25 Delta calls look like they're, let's say it's the 65 strike. Um, the bid ask spread is kind of wide. It's 205 on the bid, 250 on the offer. You could probably buy these for 2.25. If you put a limit order in for 2.25, you could probably get filled, or 220, probably get filled. So that means the stock would have to be above 67 to break even in October. Let's look at that chart. Can it get there? It could. I don't have extreme confidence. I mean, even if we go back to the lows of last October, I guess the stock did double since October. And that is what, 6 months ago? No, 9 months ago? I don't know. I don't know. You know what? A stock like this just feels like a slower mover to me. And we talked about calendar spreads earlier today. We talked about calendar spreads. Actually, you know what? I got a better idea. I got a better idea. See, this is how it goes, guys. You just kind of you kind of thinking things through as the ideas come to your head. I remember how I mentioned that volatility is not cheap. It's not super expensive, but it's not cheap. It's kind of middle of the road. You know what I think I like here more is I'm not super certain or super convinced that Guardant Health is going to rip higher. It might trend higher, right? This little move here, this consolidation can kind of continue consolidating higher. I don't need it to rip higher for me to make money if I use a bull put spread. It's a bullish trade using puts. Now, to some of you, that might sound foreign. Wait, you could do a bullish trade with puts? I thought puts were bearish trades. I thought you're betting on a stock going down. Yes, but you could also get short puts, right? You could sell puts, or in this case, a bull put spread. So let's check that out. Let's see what our options are there. Let's look in but let's do this in August options, because remember what we just said about how as you get closer to expiration, options will decay in value faster, right? So I'd rather be in something that only has 45 days of expiration, as the case here in the August options. So if I look at the August options, actually, let me pull the chart back up real quick, just kind of get the lower bounds of this range. So it looks like 47.50, 47 is about the lower end of this recent consolidation. Okay, so now let's bring up those August options again. Excuse me. There we go. So I could sell a 47 strike put. Oh, ooh, I could, but look at the bid ask spread here. It's bid 135, offered 380. Okay, well that's not good. If there's a bid ask spread that you could drive a truck through, You probably don't want to trade these options. And you know what? We probably should have done this first before we start going down this exercise. But look at these options. I mean, even the at the money options on the call side are a dollar wide, 450 to 550. That's not terrible, but it's not a good starting point, right? When your at the money strikes are that far away. But the puts are even worse, right? The puts are 280, offered 540. So you know what? I'm going to wash my hands of this stock already because it's not tradable, at least not in August. Let's see if it's different in October. It's better. You know what? Let's do it in October anyway, just for argument's sake. It's better here. Maybe the reason why there's not much liquidity in August is because these options may have just recently been listed. Okay, that's certainly possible. So all right, let's get back on track here with October options. Selling the 47 strike, okay? But I'm not going to sell this naked. And we'll talk about that in a second. I'm going to do a put spread where I'm defining my risk. So in this case, I'm going to sell the 47 puts and I'm going to buy the 42 puts to protect myself, okay? And I can bring in about a dollar, let's say 50 credit, dollar 60 credit, okay? Let's analyze this trade real quick. Oh, I am analyzing, okay. So this is what the P&L graph for this chart looks like. Let me zoom out. Let me right size this a little bit for you guys. There we go. And I'll clean up this stuff. Delete, delete. Okay, so here we are right now. Here's where the stock is trading. Now you could see that the blue line is where my, where my profits could be at expiration. Okay. Now you notice we're here. GH can actually decline from here. It could decline all the way down to around 47. And if as long as it closes above 47 on expiration day, I could potentially earn the full value of the premium that I collected today. If I collect $1.60 today and the stock expires, let's say, or closes at say 47.50 on expiration day, my two short puts expire worthless, or my two puts, I'm short one and long the other. They both expire away worthless, and I keep the entire $1.60 or 160 bucks per one lot that I did. Great, right? I don't need GH to rip higher. If it rips higher, my potential profit remains the same. The most I can make is $1.60. Okay. But if GH continues churning around here, maybe just grinds higher a little bit, maybe even grinds lower a little bit. As long as it stays above 47, I'm good. I'm still on the dance floor. I'm potentially making money. I'm probably making money. And as long as it stays above 47 before expiration, I make money. Now, if I were to put this trade on and collect $1.64 today, my rule of thumb in these types of trades, I'm not going to hold them until expiration. Until expiration. I'm not trying to earn the entire 160 bucks. That's greedy. Okay. Now, look, if GH rips 20 bucks higher in my favor and the stock's trading at 70 bucks, okay, maybe I'll feel a little bit more comfortable holding this thing all the way to expiration and keeping my entire profit. But if it does rip to 70 bucks, I could probably buy the spread back for a nickel and just take the risk off. And basically I capture the whole thing. But generally speaking, guys, I like to cover bull put spreads and short credit spreads like this for half of what I paid or half of what I collected when I put the trade on. So if I collected $1.60 today, then I'm going to put a good till cancel order out to buy it back for 80 cents, half of what I collected today. I'm not trying to be greedy. I'm just trying to take the cream off the top of the premium and earn an easy win. Okay. These are not home run trades. These are high probability trades. So, we talked about the percentage chance of gain here earlier. Right now, this trade as it is right now, if I were to put it on right now, I've got a 78% chance of winning. That's pretty high, right? Who would want to have a 78% win rate? Now, of course, that comes with the fact that you won't make a whole lot of money. These are trades that are not home run trades, like I said. And so if you have a high probability of winning, you're not going to get paid a whole lot because everybody wants those trades, right? There's competition for those trades. So they're not going to pay a whole lot. But I like this trade. I think this is the way I would play it. I would play for this little consolidation to slowly churn a little bit higher. As long as we stay above 47, we're good. If we get below 47, if things start selling off, I would cut the trade and move on because if I collected $1.60, the most I could lose is 340 because the most the spread could be worth is $5. I might have to spend $5 to buy it back. $5 less than 160 I brought in. would be a 340 loss. So I don't want to take a 340 loss, right? So if the stock does trade below 47, that's where I would stop out and take the loss. And it might not even be a loss. It kind of depends on when it happens and how quickly it happens. But that's how I would trade GH. Well, guys, we're almost to the top of the hour. So I think we're going to wrap it up here. This is where the show's a work in progress. Thanks for hanging with me. I hope you guys found this instructive. We'll be doing this every week. And we'll be soliciting questions. I didn't really look into the chat for ideas. I don't think I needed to today. It doesn't look like there are any. I'm looking right now. I see some friends in there. Hey, Phil. Hey, Jay. Hey, Chris. Good to see you guys. Thanks for tuning in. Hi, Rachel. Good to see some familiar faces. We'll be back next week doing it. And if you guys want to shoot me stocks you want to hear about, if you're in the All-Star Options chat room, that's definitely the place to hit me up. You get me the fastest. You can hit me on Twitter, of course, or shoot us an email, info@allstarcharts.com. And those questions, they'll get to me. Those emails will get to me. All right. So thanks, guys. Thanks for tuning in. It's a holiday shortened week, but I'll be back on camera on Thursday with the regular weekly options jam session where we review open positions in the All-Star Options service. Any trades we've exited or adjusted or anything that needs our attention, we will review. So it's a great show. If you guys haven't watched it, it's on Thursdays, right on the same channel here on the Stock Market TV channel. So please tune in. Thanks for hanging with me, guys. I'll let you go. Enjoy the rest of your day. And if I don't talk to you before the end of the weekend, enjoy your long Independence Day weekend. Happy summer. Be well, everybody. See you again next time.